masterclass is to kind of share some basic elements of blended finance, and then also share both from SAMRITH perspective, and then later Priya will be sharing a perspective from Samita's end on what have been the practical experiences around blended finance in the Indian context. But in terms of first to understand that how does blended finance work and why is there a requirement for blended finance and how it's being perceived as a powerful tool for impact globally, I think the discussion possibly needs to go back to the Sustainable Development Goals, which we set for ourselves globally around 2015, that by 2030 we will achieve these goals. But to achieve these goals, whether it's in India or globally in the lower and middle income countries, there is a requirement of a lot of financing. And
Himanshu, one second, Himanshu, there is a request for you to speak a bit louder. Couple of people have said.
Sure. Am I audible? Is it better now?
Yeah, it's better.
Yeah. So there is a need for significant amount of financing to come into the sector, and these figures go into trillions of dollars if SDGs were to be achieved at India level. DA that goes into this sector, it has been only minuscule in terms of what the requirement is. And even if you combine the government funding going into the social sectors or the impact focus sectors, that also does not give a lot of confidence in that our ability to achieve the SDGs with the amount of money going in. This all has over the last few years brought in pressure on philanthropic capital, and there has been a feeler that possibly philanthropic capital can come in and fill up this gap. However, if you look at the overall philanthropic capital also coming into this space, while it's been increasing specifically in case of India, it still will remain insufficient to achieve the SDGs. And then that's where the most critical part comes in, that unless or until private investments start flowing into this space of development finance, we are far away from achieving what we have set ourselves to. And to get this private investment into place will require collaborative strategies. And that's where the entire concept of blended finance comes in, that when we kind of combine the private capital and development funding to create structures which not just help implement projects on the ground, but do that in a manner that the impact is achieved and the goals that we have set ourselves to, we are closer to them. Social enterprises, it increases the access to capital, and basically it does that by de-risking the private investments that are expected to come into the space. And at the same time, for the philanthropic donors, it's giving them a leverage of at least 5 to 10x of the money that they intend to spend in the impact space. What that means in a simple language is that for a traditional grant funded program, which all of us have been used to in the past, if you're spending $1, you are getting results of $1 if the program is implemented properly, and maybe a little more if you get a few other partners to join in with you. But if you get in the power of private investment behind it and use blended finance structures in a proper manner, you can multiply that effect to 10x and even more in some cases. And this has been proven again and time and again through the various blended finance structures that have been implemented over the past few years. At the same time, for the commercial lenders who are bringing in this private investment, what basically it's overall doing is that it's de-risking the investment for them. They are getting us kind of a comfort while investing into social enterprises or a socially focused program, that if there is a default, there is some amount of safeguards that they have backing us. So what that allows them is to take bigger bets, which traditionally they may not have been able to take. So for blended finance, one of the key component becomes that you have to unlock the commercial finance, commercial capital coming into this space. But one may ask that why doesn't commercial capital automatically flow in this sector? There are a few reasons behind that. One being, and these are very important to understand, specifically from the perspective of the corporate CSR groups and the philanthropic groups who are looking at blended finance as a possible solution area. Because unless we understand these concepts, it will be difficult to structure blended solutions which bring in this commercial capital. So one is that traditionally these sectors that we are talking about, the impact focused sectors, whether it's health, education, agriculture, climate change, skilling, etc., the risk perception is that you get lower than expected returns, or the market returns that are there that you can get from other commercial initiatives. This happens because of the various market inefficiencies that exist in this space, uh, which kind of results in limited incentive to invest for the commercial financiers to come and play in the impact financing space. Because ultimately, all commercial players are kind of looking at impact for, return first and impact second kind of an approach. And what blended finance is trying to do is kind of merge this commercial ideology to the philanthropic ideology of impact first and return later. Moving forward, so blended finance overall is trying to bring in the leverage, it's trying to bring in the impact, and it at the same time ensuring returns for the commercial capital. And that's how it's becoming kind of a win-win kind of a scenario for all three or two players that one encounters in this space. So the philanthropic capital gets a leverage, gets the impact, and the commercial guys are able to de-risk their investment and get the returns that they usually expect to come from any investments that they make. And by doing all this, blended finance has the goals for sustainable development kind of mandate, because it's ultimately going to reduce the dependency on government programs and also towards debt and sovereign guarantees, which we have been traditionally focusing on, or commercial sector has been commercially focusing on when they want to come and invest in impact sectors. More so, it will help in developing commercially viable social impact projects. So right now, traditionally, if you see the market of development or international development largely, it has been purely grant driven. And once the grant kind of stops flowing in, you see that either the projects end, and there are very few projects which kind of are able to sustain themselves beyond the grant period. This becomes a bigger problem when the country as a whole is kind of moving towards middle income group, like in case of India. And as we would have seen over the last few years, many of the large ODA providers have kind of gradually moved away from the Indian market because they see that India itself is a large economy now and does not require grant funding to come in form of ODA or other forms. So unless and until you have commercially viable social impact projects market developed in the country, it will become difficult going forward to reach to the vulnerable populations in a sustainable manner. So how does blended finance work? Basically, it's a kind of a smart use of developmental funding, whether it's coming from the likes of ODA or the philanthropic funders, to mobilize private capital, and so that the private capital gets market rates. Development funding acts like a concessional prices, implement programs on the ground. There are various forms in which blended finance structures can work. I will briefly touch upon the broad three categories around this. So one is where a blended structure basically makes funds available at below market terms to the social enterprises. So what's happening in this kind of a structure is that while the commercial investor is making the returns at their own level, the development funding that's coming in from philanthropies and other grant providers is providing that support at below market terms. So the blend of the two capitals is at a lower rate for the social enterprise that's intending to scale up their operations or work on the ground. So that's one form in which a blended solution can work. The second form is in form of a risk guarantee and insurance. So this works, this kind of a group of instruments works where the private capital finds it too risky to invest in a particular group of social enterprises, maybe because of their past experience, maybe because of just pure perception that those kind of entities cannot give you return, or maybe because of structural requirements. So most lenders, as we all would know, require some kind of a collateral to be there when they're advancing money or giving loans to any entity or individual. So in those kind of a cases where those entities don't have availability of that collateral, risk guarantees or insurance come into play. And if development funding can be used to create that kind of a risk guarantee, that helps the social enterprise access the funds. The third kind of structures are around technical assistance and the design stage grants that basically go in towards strengthening commercial viability of any enterprise or who is trying to work on the ground. So this is where basically the development funding is going towards building the capacity of the social enterprise or creating a structure which can enable their access to the financial resources, not necessarily providing concessional capital or risk guarantee. So now all these three groups of instruments under blended finance have different levels of applicability depending upon the case scenarios that one encounters, and also to service the sometimes the mandates that the development funding providers, whether it's the large philanthropies, CSR groups, or institutional donors may have. Within these three groups, there are several instruments that can be structured, and these sometimes are different names for a same kind of a structure. But what I want to kind of highlight here is that for each and every case, each and every requirement from the perspective of the commercial provider or from the perspective of the development finance or funding provider, there are enough options available which have been tried and tested both globally as well as in the Indian context, which can provide a solution, which can provide a blended finance solution. These range from things like returnable grant, partial and first loss guarantees, interest subvention. We will cover some of these instruments in the later slides as we move forward. So what is prerequisite for a blended finance transaction to work? Now, typically speaking, grant funding traditionally has been going to not-for-profit entities who receive the grant, do really good amount of work on the ground, but once the grant ends, the project in most cases comes to an end as well, and there is no sustainability and scale up beyond what the grant money can provide. So the first basic issue that blended finance often tries to address is that it looks at the investment from the entity level instead of transaction level. What that means is that you're not funding a project per se, but you're supporting an entity which has a goal or aspiration to do A, B, C kind of activities. Now, what this transacts into is that rather than looking at a project or a transaction, when you're looking at an entity level, you're automatically working towards sustainability of the initiative and ensuring that in the long term, the project or the entity will continue doing the great work that they intend to do or they have set up themselves to do. As a result of that, it results in the scale up and expansion of the business, again leading to sustainability in the long term. It should also enable the entity to progress from early to mid revenue or launch the commercial journey. So often what we find is that blended finance transactions work best for early stage initiatives where the entity is in their early and mid revenue space, where their balance sheet is not that strong to be able to for the lenders to provide them the finances. So it kind of helps them, or if a blended structure can then, if this prerequisite is met, can help those entities to launch their commercial journey going forward. It kind of attracts lenders or risk investors' participation into the structure, demonstrates leverage. Now, this is again very, very important because grant funded, as I mentioned earlier, typically gives you a 1 to 1x kind of a leverage. You invest $1, you get results of $1 in best case scenario. But in case of blended finance transactions, typically speaking, for every dollar that you put in from donor or CSR fund, you can expect interventions of at least 3x, 5x, 10x being implemented on the ground, and giving you impact that many-fold. It can catalyze pathways to unlock more commercial capital subsequently. So it's not just that you're doing this transaction one time and you're getting that leverage, but you're actually also building the capacity of the enterprise by using the blended finance structure so that beyond that particular structure working, and once that structure comes to an end, the entity is ready to raise commercial capital even without getting further donor money coming in. And ultimately, everything what we are trying to do here should lead to the borrowing program becoming much more structured for the entity or the group of entities that we work with, and maybe get listed in platforms like social stock exchange, which are coming up in case of India as well now. So just to summarize that, when we are looking at a blended finance transaction, there are the key parameters that one needs to look at. That it has to be a business model. There has to be some kind of sustainability plan built into it. There has to be unit level viability in whatever that entity is trying to do. The project or the intervention that the entity is implementing on the ground should be commercially viable. It should not be just that you are pumping in money and there is no revenue source or no mechanism to ensure that the project is going to be self-sustainable or not in itself. The management capability of the management team of the entity is very, very critical. It should be competitively positioned to the market, or should have the ability to be competitively positioned. And lastly, but not least, there has to be market opportunity for that kind of service being delivered on the ground. So if these kind of key parameters and prerequisites are kept in mind, blended finance transactions can really work well for social enterprises in getting the desired level of impact and leverage on the ground, and ultimately help us in achieving the sustainable development goals. We had come as part of the SAMRITH program with the blended finance white paper along with NITI Aayog, and this is available on NITI Aayog's website as well. And I would encourage that whoever is interested in taking this forward to at least have a look at this paper, because it kind of gives you in very simple terms the very basics, some of the things that I mentioned earlier, the basic prerequisites and how a blended finance transaction can work in the healthcare space. But having said that, what is applicable in the healthcare space can easily be replicated to the other sectors as well. So whoever is interested, I would say that post this session and before the future master classes, it would be really useful if somebody was to kind of read through the white paper, and we would be also happy if they had queries to kind of address those post that. Before we get into the Q&A, just want to give you a few examples of how blended finance transactions actually look like on ground. The various structures I mentioned about earlier, just giving you a flavor of how things can be implemented on the ground through your funding, through the projects that you may be already doing, how blended finance can be built into those projects as well. So I will just start by giving a brief background of the SAMRITH blended finance facility, which was established with support from USAID at the onset of actually COVID pandemic, and over the last 2 years has been working in the healthcare space and bringing blended finance solutions on ground, implementing them, and has seen some amount of success till date. So this particular facility, as I said, started with initiation from USAID and IP Global as the implementation partner. And the idea here was that at the onset of the pandemic, we kind of got a request from the National Health Authority that there is going to be a huge pressure on the health systems per se in the country. And can we come up with a financing mechanism which can help in addressing this huge surge demand that the sector is going to see, both for catering to the infrastructure upgradation requirements, as well as to address the emergency requirements that the pandemic is going to throw to us. So when this request came to USAID and IP Global was part of those discussions, the thought process was that pure play grant funding will be only able to go to, say, 1 or 2 miles. It will not be able to take us to the end point that one wants to achieve, or to address all the kind of challenges that the pandemic is going to throw on us. So the idea came that, okay, can we look at using grant capital much more strategically, and see that it can bring in more commercial capital into the space, have the private sector invest money into this sector, even in times of pandemic, when generally speaking, the markets were crashing everywhere and the commercial investors were kind of had gone into an huddle. So with that kind of a thought, SAMRITH was started and IP Global became the technical support unit there. And on the grant pool side, what we did was that we raised a pool of grant capital from different kind of sources, from the likes of USAID, Rockefeller Foundation, Crypto Relief, etc., Ford Foundation, etc., as well as a few CSR groups. Uh, so that was one piece of the story, that we raised initially a grant pool. And parallelly, we also worked with a lot of uh, commercial investors, starting from large national banks like IndusInd Bank, Axis Bank, HDFC, Caspian Debt, and the like of development finance institutions like DFC. And the idea, as I mentioned earlier, was to kind of then work towards merging these two pieces of capital to invest in healthcare enterprises. Uh, I'm happy to say that over the last 2 years, Samrit has been able to kind of test this concept quite well. We were able to raise grant pool up to $30 million, get commercial commitments of around $270 million. Overall, the facility has become kind of a $300 million facility, purely looking at blended finance structures getting implemented on ground. And to enable this entire program, we also have a strong advisory committee, which kind of consists of leadership from Government of India, foundations, lenders, as well as corporate PSUs. And over the last year and a half since when we started investing, we have been kind of uh, implementing blended finance structures across the healthcare ecosystem, starting from oxygen solutions to ICU beds, ventilators, vaccine, cold storage solutions, etc. And how, and now, like, it's important to see that what does it mean on ground when you talk that, okay, what all this sounds fancy, that this kind of a facility has been created and been investing for the last 2 years, but what does it mean when it comes to impact on the ground? So just to give you a brief kind of a feel of what blended finance is capable of doing in a short period of time. So over the last 1.5 years, the Samrit facility has made 32 investments. And when I say 32 investments, we have supported 32 solutions. And as you can see in the map below, these have had pan-India presence because we have been helping a lot of entities to scale up their operations at a very fast pace. So the capital that we have provided them, the grant capital, as well as the commercial capital that it has enabled, has really helped these entities to scale up their operations across the country, and some of them even globally have expanded their footprint. So these 32 solutions, as I mentioned, have been across the spectrum, and some of them, in fact, have been not-for-profit entities as well, who wanted to move away from the pure play grant model to a commercially sustainable revenue generator model, with, of course, no profit or very low profit margins. But the idea was that it has to be commercially sustainable. For these 32 solutions, we have kind of used roughly around uh, 12 million of grant capital, and within these 32 solutions, 100 million of commercial capital has been mobilized. So again, at a portfolio level, it's a clear leverage of around 8 to 10x. At 12 millions of grant money led to 100 million of investment on the ground, bringing in the commercial capital. In terms of numbers, these 32 solutions have a reach of around 1,200 plus health facilities, starting from tertiary level hospitals to primary healthcare facilities. Uh, as part of this program, around 14,000 health professionals have been trained. 20,000 health professionals have been trained, and these have been doctors who got trained during the time of the pandemic on emergency care, to nursing and community health workers, as well as staff required for diagnostic services. So a range of health professionals have been trained. In terms of reach, these 30 entities now have a reach of around 30 million people. That's their serviceable market. And the 5.7 million people have been directly impacted over the last year or so by these 32 entities. So that again shows that how a blended finance structure can take things to scale and get you results at a large scale rather than in particular geographies, which typically the grant models have been used to be providing us. Now coming to some...
Himanshu,
Yeah.
is it okay? We are getting a lot of questions from the audience. So if you
Sure.
can, a lot of interest in your earlier slide. So maybe if I may, on the behalf of the audience, and this is a little unconventional, I'm just breaking the
Sure.
flow. If you can just go to the earlier slide. I think people just go to 2 slides earlier. Yeah. So people just want to understand 2 things. One is basically you had $30 million of grant. In the normal case, that $30 million of grant would have been given away by all these people, USAID, IIT Delhi. But instead of giving away 30 million, you raised another 270 million or something in that zone, right? So totally you raised 300 million. Right. And this money, you gave it out to all these organizations that you have put on the next slide, for doing whatever social impact that they are kind of doing.
Yeah.
Right.
So that's so overall we have raised
maybe Himanshu, is it okay if you for 2 minutes you can just talk about this, because I think people want to understand how that grant capital attracted the commercial capital, and also what kind of, is this more in the form of debt or did you support equity? Maybe if you could just talk, because I think this is a very simple but very easy example. Because, the way simply I'm looking at it is that if I was in IIT Delhi, I had $1 million, I would have given it away. Now you're telling me instead of 1, I'm actually putting $10 million in the market. So that's a huge thing, because I can now help people with $10 million instead of 1 million. So I think maybe we can take a minute here, Himanshu, to just talk exactly how you are doing this.
Sure. So, Ramraj, you're right that from the $30 million grant money, we have been able to get commitments of 270 odd millions of commercial capital in form of mainly debt, but we have also enabled equity for the 32 solutions that I mentioned. But when it comes to the actual usage of this money, we have only used 12 million of the grant money so far. And with that 12 money, 100 million of commercial capital has been deployed on the ground. Rest is still something which we are working towards deploying. So now how it works is basically when you have this kind of a commitment at first place that these philanthropic organizations have pooled their money at in a structural manner to be used for blended solutions, then you can go with confidence to the lenders or the commercial investors to structure blended finance solutions. I will just take a very simple example of the structure that we have established with Axis Bank, which is a $150 million facility, of which we have right now rolled out the first phase of roughly around $40 million. Now, how this works is that health, as we all know, is a priority sector lending in the country. But having said that, each and every commercial bank ends up paying huge fines to RBI because they are not able to meet their priority sector lending targets. And priority sector lending, like, in making providing loans, term loans, as well as working capital loans to the healthcare enterprises, whether these are startups, hospitals, or other networks or ecosystem players. Now, why don't they provide that kind of a loan? Because they feel that these investments have a long gestation period and are riskier than other sectors, and possibly also because health being a very technical and a niche sector, sometimes the banks don't have the capacity to understand how different models work and all. Now, when we go to a bank and talk about blended solution, what we say is that what will help de-risk your investment, what will help you to put or invest more money in this kind of a sector, and different kinds of solutions come out of that. Some could ask that, okay, can you provide some kind of a risk guarantee to us? Risk guarantee would work in a typical way, could be a partial risk guarantee or a first loss guarantee, where we are saying that, okay, you lend, say you give loans of say 200 crores, and if a default happens, we will take care of say 10%, 20%, 30% of that in form of a partial risk or a first loss guarantee. So that gives banks a comfort that, okay, even if my portfolio is not as strong as other sectors I invest in, because of this risk guarantee, I'm having a safeguard. But because you then jointly select the entities that you are going to work with, and besides providing them the financing support, you also provide the entity technical advisory and business advisory support, the default rate is going to be much lower.
So Himanshu, what you're saying is, just to sort of summarize it, is that there is 30 million of grant, and for a moment, let's assume that 250 million of debt has been raised. So totally 270 million of debt plus 30 million of grant, 300 million, let us assume it is deployed in the market. So you guys have lent out that 300 million in the market. Now, all of this 300 million is given in the form of debt and has to be repaid, right? So let us say now you get back only say 280 or 285 million. What will happen now?
So these debt that is there, that is between the entity and the banking partner. And what we have seen is that because you are giving money to commercially viable institutions, the money would come back to the banks, and the debt will come back to the banks. There can be some kind of a default. So if a default happens, that's where the risk guarantee comes into play. That's where the donor funds come into play to kind of provide that support to the banking partner. But what we have seen is that the NPAs in these transactions are at the same level what the banks otherwise also face, or even sometimes lower, because
but in case there are defaults, Himanshu, then that 30 million can be used to take care of the default. So if the bank is losing any money, up to that $30 million, that money is available as a funding to make good whatever the losses the bank has suffered. That is broadly the structure that you're looking
at. So that's one structure. That's one structure which is.
Himanshu, I'm just trying to give a high level thing. I'm just trying to give people a perspective that and all of this is CSR approved and all, I presume, all of your grant pool and all that, right?
So the structure that we have actually worked with Axis Bank is very interesting. It's an interest subvention structure where the entities are getting if they meet certain outcomes, they get an interest subvention. So if, for example, if the bank is lending them at 10%, if they meet certain social outcomes, just to give an example, a hospital takes a loan to expand their infrastructure, we tell them that if you are currently, for example, serving 10% PMJY beneficiaries, if you take that 10% to say 25 or 30%, we will pay partly your interest cost. So that becomes a very interesting situation for the health enterprise. So that's the kind of structuring also that we have done. There are several other instruments that have been, and all of this is compliant with FCRA and CSR rules, and that's where IIT Delhi comes into play because being an institute of eminence and all. So this is one example.
Great, Himanshu. Sorry, I just came in at that point. I thought it's just good because a lot of people are asking the question. You may not be seeing them, but I was seeing them. But please go ahead to your next structure, Himanshu. Sorry.
Sure. So this is one case study of how this looks, or these kind of transactions look on the ground. So BlackFrog Technologies is a early stage startup incubated within India, made in India kind of a story, which basically manufactures portable active cooling devices for delivery of vaccines and other biologicals to the last mile. So typically we have been seeing those thermocol based cold storage in the country, which is of course very cheaper, but over years we have seen through research that it brings down the efficacy of the vaccines because there is no way of ensuring that the cold chain is maintained till the last mile, especially in hard to reach areas. So this is a solution that comes into play there. Now, this particular entity, when we kind of started working with them, had basic challenges. They had the device, the prototypes ready, but didn't have the manufacturing facility available. They had few orders, but didn't have the working capital to service those orders. So that's where we came in as SAMRITH with IIT Delhi, Caspian Debt, and IP Global as the investment managers. We gave them a basic support of only $200,000, which came in from development funders like USAID and Rockefeller Foundation. And what we did was that using that $200,000, we used 4 different instruments in structuring the investment to cater to their specific requirements. So they wanted to take a loan from a banking institutions, in this case Caspian Debt, but because they didn't have a strong balance sheet, Caspian Debt was not able to lend them. So we provided a partial risk guarantee to them, saying that, okay, we are backing this particular entity. You provide them the loan. We will give the partial risk guarantee that if the entity is not able to pay you back, the risk guarantee will come into play, specifically what Ramraj was mentioning. The second instrument we used was interest subvention, because we knew Caspian Debt being an NBFC, the interest rates are at a higher range, can be anywhere from 15 to 16%. Now that kind of interest rate a startup is unable to kind of service. So we provided them interest subvention also. And the idea here was that if you are able to manufacture X number of devices and supply to X kind of institutions which are impact focused. So we are not saying that you are supplying these devices to, say, purely profit making entities, but if you're supplying it to entities which are working with the vulnerable population and all, we will provide you the interest subvention. But with these two things also, they were still having a gap in terms of building their manufacturing capability and servicing the orders. So we also gave them a returnable grant, which was that, okay, you have orders in place, your manufacturing capacity can come from the loan that you have taken, but the working capital, take this returnable grant, service your orders, and return the money back to us once the orders have been serviced. So these 3 structures we used and very effectively, and now the entity is not even only manufacturing, but also supplying across the country. And actually the photographs that you see on the right are different social other NGOs using their devices on the ground. So Doctors for You has been using their devices to deliver vaccines on the ground. Similarly, many other small NGOs have purchased their devices to do vaccination programs on the ground. What we have also done along with this entity is that we have also provided them technical advisory support, not just for the Indian market, but also to take them to East Africa. So now they also have orders from different counties in Kenya to supply their devices. So overall, this kind of a support SAMRITH has provided to this entity, and you can assume that other 30 plus entities also have got similar kind of structuring done or similar kind of technical support being provided. And by doing this, we have been able to leverage roughly around 3 to 5x on the investments that we did. So this leverage came in form of the loan that they were able to access. At the same time, the commercial entity, Caspian Debt, was able to achieve the commercial returns that they're looking for. So they are able to invest in a socially focused business, able to get commercial returns. We are able to get the leverage, and we can also see increased on-ground impact in form of whether the vaccines being administered, and we being confident that the vaccines that are being administered have not kind of broken the cold chain and are at their full efficacy level. The other I kind of briefly touched upon is the social success note model that we have structured with Axis Bank. So here it's a $150 million facility that we have created with Axis Bank, through which they will invest anywhere from 5 crore to 15-20 crore kind of loans to healthcare enterprises across the country. And these healthcare enterprises could be hospitals who are looking to expand their, say, bed capacity or diagnostics capacity. These could be early stage companies who are looking for setting up their manufacturing units and all. These could be NGOs trying to work on the ground and implementing health programs, which have programs like, say, mobile medical units or primary healthcare centers where they have a revenue model. So all these different kinds of entities can access this window. And what we do is that loan is provided by Axis Bank at commercial rates. What we say is that if the entity is able to achieve ABC outcomes, we will take care of part of their interest burden, so that it becomes more commercially viable for them at the entity level to service that loan and to expand their business further. So this social success note has been done with Axis Bank, as well as initially, first we did it with Caspian Debt at a smaller scale, and then it got, based on the success of that model, Axis Bank took it to a totally different level. And now we have seen that by doing this kind of a portfolio level transaction, which uses money coming from corporate CSR as well as institutional donors, we are able to kind of change the mindset within the banking and the sector and the financial institutions in the country, who are over a period of time will be able to see healthcare enterprises as commercially viable, and maybe in future years provide them support without any kind of blended structure coming into play. So these were the broad two case studies that I wanted to touch on.
Himanshu, if I may again just go back to your earlier slide, if I may just take again 1 minute, just now same one, social success note.
Right.
So maybe it will be useful. Yeah. So why would we want this social success note? You have, I mean, I am working with a social enterprise. I just give them my money, right? Like I have 5 crores. I'm a philanthropist. I can just give the money directly to the social enterprise. Here, from the structure you have created, basically the social enterprise has taken some loan from one investor. That is the first point, number 1.
Right.
Okay. And then this social enterprise, from what I'm seeing here, is it has to create some social outcome, whatever that social outcome can be, health or whatever it is. Somebody is monitoring it, which is that guy at the bottom, monitoring and evaluation. Somebody is monitoring that social outcome. And in case that social outcome is achieved, which is what you're shown in 4B, then somebody is paying that investor, and then the money goes back to him, right? So why would somebody be interested in a social success note? If I'm a philanthropist, shouldn't I just be giving my money to the social enterprise? Now what are we doing? Social enterprise takes a loan, then they create some outcome, then I pay somebody, and then the money goes back to the social enterprise. So talk to us a bit about why is a social success note, why is it relevant, and why is it that we should be doing structures like this?
So the one basic parameter here is that the social enterprise that we are talking about a sustainable business being built, which will run beyond the grant money being provided, whether it provided directly or as an outcome payment. And that's very critical, because if a philanthropic donor, they can very well, and they right now also do, provide direct grants to social enterprises or NGOs. But what it does is that till that grant money is there, that enterprise works in that particular region, geography, or sector. But once that grant money is done with, they're either looking to raise future grants or stop the initiative per se. Now, what this kind of a model enables is that this is bringing, I would say, financial prudence within the sector. So you have a social enterprise who is taking a loan from a banking partner, and by that taking that loan, they are, both the bank is also ensuring as well as the social enterprise is also ensuring that they have a commercially viable model, which has a revenue source, which can bring impact on the ground, as well as has the ability to service the return requirements of a commercial investor. Now, it may happen that in the early years of that intervention, the social enterprise is not able to match the market returns that the commercial investor may be looking for. So, for example, in case of a bank, typically a bank would be lending at around 10 to 12% to any kind of an enterprise. Now, a social enterprise may not be able to service that level of interest in their initial years of operation. And that's where this, if the philanthropic capital is used strategically as an outcome payment, the philanthropic donor is able to ensure that A, this enterprise will be sustainable in the long run. B, the business model that is there, it gets tested on the ground, and is able to also achieve the outcomes that the philanthropic donor has specified. So it's kind of becomes a long-term play rather than a transactional play that you give the grant, burn it, end of the story, to something which even is going to even last beyond your support. So that's the basic, I would say, the reason why donors should be looking at these kind of structures rather than a pure play grant. And from the banking point of view, also, it will slowly build the confidence of the banking sector in lending to these social enterprises. Going a bit more in detail there. So typically what happens for a banking partner is that if, for example, their interest rate that they're charging in sectors where they are fairly confident the money is going to come back easily is say 10%. For harder sectors like health, education, agriculture, where their risk perception is higher, they will automatically increase the interest charge out to those sectors to say 12 to 13%. So the idea here is that by implementing these kind of models, in the long term, we will also build the confidence of the banking and the financial institutions towards these social sectors. And once they have invested enough in them and seen that these enterprises are equally capable of returning their money, the interest rates automatically will also come down for these sectors. So these are the two things which will change over time if philanthropic capital gets used in this manner rather than a pure play grant.